All right, so we left off talking about management assertions. I want to finish up talking about that today. And we covered, remember, there are 3 categories of management assertions. So if you look in the textbook, chapter 1, you'll see that there are management assertions that are PCAOB assertions versus ASB assertions. And the management assertions are the same across, whether it's PCAOB or ASB. The only difference between the two is that the ASB breaks out the assertions in more detail. So they break out the assertions in terms of categories of assertions, whereas the PCAOB doesn't. They just lump them all together. So for our purposes, for this class, I want you to concentrate on the ASB assertions in the way that the ASB presents the assertions, which is by category. And so we talked about 3 categories of assertions, one being assertions dealing with transactions and events. And so those are really the assertions that management's making with respect to the economic transactions that the company engaged in, right? And that's really what is going to flow through your income statement, sales, expenses, right? So those are the things that flow through the income statement. And then there are assertions about account balances, which management makes assertions that, yes, I have cash of $10 million, or I have accounts receivable of $5 million, right? They're making assertions that the amounts recorded in the balance sheet are true or valid, right? So those are assertions about account balances. And then the final category is the category of assertions about presentation and disclosure, right? And so that is exactly what it suggests, that it's assertions about, yes, we recorded all current liabilities are truly current liabilities, right? Or all current liabilities represent obligations that the company is obligated to pay within a year, right? So that's about the presentation. That everything that's included in the balance sheet represents assets, liabilities, and owner's equity. Items that are flowing through the income statement pertain to the company's operations. And then disclosures, obviously the footnote disclosure, assertions about the footnote disclosures that accompany the financial statement. So those are the 3 categories of assertions. So we left off talking about management assertions about classes of transactions on Friday. That's where we ended. And the takeaway here is, if you look at it, we have the assertions that management makes. Auditors, the audit is developed, or the audit approach is developed around this framework of assertions. So that's what we mean here about general transaction-related audit objective. What's the audit objective related to occurrence? Well, obviously, auditors want to ensure that recorded transactions exist. So they're going to design their audit procedures to determine that the recorded transactions, those amounts that are reflected in the sales journal, actually exist. They represent valid transactions. They did occur. So for example, what the auditor is concerned with when they're testing the occurrence or gathering evidence related to occurrence is that sales are not overstated, right? They're concerned about overstatement of sales. So they want to make sure that they do exist. So they're going to design audit procedures to test that recorded sales are for shipments made to non-fictitious customers. And the reason that we use shipments, right, as a proxy, right, that's a good indication that the sale occurred, right? Because under GAAP, that is one thing we look for. We look to see that the shipment, that the sale is earned, that there's been this arm's length transaction. And one way to determine that is, did we ship the goods? So if you think back to your financial accounting, one of the things that you would look for to determine that the sale is a valid sale and should be recorded in the current period, right, is that they actually ship the goods, right? FOB, shipping point, right? So the ownership of the goods transfers to the customer when it's shipped. So that's why shipping, right, is a good indication that the sale actually occurred. So the auditor is going to look for evidence that the shipment occurred. Right. So that's occurrence. And then completeness is they're worried about understatement, right? Because they want to make sure in this case the management is asserting that all transactions that should be recorded have been recorded. So the auditor's objective is to make sure that all sales that have occurred are included in the sales journal. So a completeness is concerned about understatement. So now the auditor is going to gather evidence to ensure that for all of those shipments that were made, that the client has actually recorded the sales in the sales journal. Right? So make sure you understand the distinction between occurrence and completeness. Occurrence, the auditor's concern is overstatement. Completeness, the auditor's concern is understatement. Right? And then, so we'll go through more examples of these. And then we finished off talking about accuracy. And with accuracy, the auditor is concerned, actually, obviously, that the transaction is recorded at the accurate amounts and that they've been posted to the correct account. So you want to make sure that sales to customers don't include sales to related parties, right? Because related parties should not be included in your sales. And then classification, if they're properly classified, and cutoff, the auditor is concerned with timing. So they're concerned with whether or not the sale actually occurred in the reporting period. So if the client's fiscal or the client's year end is 12/31, the auditor wants to look for evidence that all sales that should be recorded as of 12/31 have been recorded in the correct period. Right, so that is, these are the assertions related to transactions, using sales as an example. The key point here is that it doesn't matter what cycle you're looking at. So even if you're looking at the acquisition cycle, if you're looking at the inventory cycle, your transactions and events, the assertions you make are the exact same assertions. Management is making the same assertions about transactions and events across all cycles. The difference is the auditor's objectives will change, or the audit procedures will change, right? So if we're talking about acquisitions, for example, the auditor is still going to be concerned whether or not that acquisition actually occurred, right? So they're going to look for evidence to ensure that the transactions that have been recorded in the financial statements or in the income statement actually occurred. The audit evidence they collect will be different, right? So obviously they're not going to look at shipping documents to determine if it occurred. They're going to look, for example, at receiving documents, right? Because the receipt, if we accept as a customer, if our client accepts the goods in their warehouse, there's evidence that they are obligated to pay for it, right? So it's a valid transaction. So it's just your audit evidence that changed. Management assertions are the same across all cycles. So now let's talk about management assertions about account balance. So remember, these assertions are assertions that essentially the management is making about the amounts recorded in the balance sheet, right? Because that's where our account balances are, right? At month end, year end, we close out the income statement to the balance sheet. So the balance sheet is what's carried forward every year from one year to the next, right? So management's making assertions that the amounts that are recorded in the balance sheet exist. We do have cash. Management saying we do have inventory. We do have accounts receivable. They exist, right? We didn't make this up. So management's making an assertion that all asset liabilities and equity accounts exist. Auditors' general audit-related objective, in general, what the auditors are going to try to do is to obtain evidence that these amounts do indeed exist, right? And so, for example, the auditor would get, let's say the auditor is looking at accounts receivable. So the auditor would get the accounts receivable age trial balance, select a sample of customers, account balances for customers, and confirm those account balances. And we'll talk more about audit procedures related to the account sales cycle when we cover that. But the confirmation is getting third-party verification from the customer saying, yes, we do owe XYZ company this amount of money. That's evidence that the account exists. A customer is not going to confirm an account balance if they don't owe you money. So that's strong evidence that the account does exist as of year end. Also, the auditor is going to test for completeness. So notice we assertion about completeness. with respect to transactions. There's also an assertion about completeness related to account balances. And again, the auditors want to make sure, management asserting that every asset that should be recorded has been recorded. Every asset we own is reflected in the accounts. So it's complete. Every liability that we're obligated to pay is reflected in the accounts. So the auditors making those, the client's making those assertions. The auditors want to obtain evidence that they are complete. So for example, with liabilities, shift gears a little bit, the auditor would be concerned that the client has accounted for all of their liabilities. So one thing that they might do is to do a search for unrecorded liabilities. Right? And a search for unrecorded liabilities would include procedures to determine that whether or not there are any liabilities that the client is obligated to pay that they haven't paid. So that would be a test that the audit procedure that an auditor would perform to ensure that liabilities are complete. So then the other thing with the other significant assertion would be assertions dealing with valuation and allocation. So if you think about the balance sheet and the accounts in the balance sheet, we have what we call contra asset accounts, right? So we have the allowance for doubtful accounts, we have inventory obsolescence, we have accumulated depreciation. If you think about accounts such as the allowance for doubtful accounts, for example, or inventory obsolescence, right? One of the things that's significant about those two accounts is the fact that they're estimates, right? Management has to estimate what they believe their allowance for doubtful accounts should be, right? So the reason for that is so that on the balance sheet, the accounts receivable account is reflected at its net realizable value. Remember that, right, from your financial accounting? You have to reflect accounts receivable at its net realizable value. So the auditor management is making these assertions that, again, those accounts are reflected at their net realizable value, and it's at the appropriate amount. So what the auditor is looking for to test their objective with respect to this assertion that management is making is that it's accurate, that it's recorded at the correct amount, that it's classified properly, there's cutoff, that it's recorded in the current time period, in the correct time period, that the account balances agree with the master file. So for example, that the auditor can reconcile, or there's evidence that the client has reconciled the accounts receivable, the amount recorded in the general ledger for accounts receivable to the accounts receivable subledger, or the amount that's recorded in accounts payable reconciles to the accounts payable subledger, so that that there's evidence that they agree. So that what the auditor is looking is to see that those detailed transactions have rolled up to the general ledger accurately. And then the realizable value of those assets are included at their net realizable value, such as accounts receivable, net of allowance for doubtful accounts, or fixed assets, net of allowance for accumulated depreciation. So with respect to that, some of the audit procedures that the auditor would perform would be to make sure that amounts that are included in the trial balance are accurate, right? So the subsidiary ledgers. The accounts receivable age trial balance is correctly classified, right? You should only see in accounts receivable trial balance accounts receivables or transactions resulting from sales to customers, not transactions with employees, not transactions with related parties, but only to sales to customers, that they're recorded in the correct period. Right? So in the confirmation process, for example, the auditor might look at when transactions occurred. When did the sale occur? A detailed tie-in, they're going to ensure that the client has reconciled the detailed trial balance to the general ledger. right? So that the amounts that are recorded in the subsidiary ledger rolls up to the general ledger and all reconciling items have been resolved. Same thing with cash. You have a bank reconciliation, right? Detailed information in the bank, from the difference between the bank balance and the book balance has been reconciled, and reconciling items properly identified and resolved. And then finally, rights and obligations would suggest that the client is saying these assets belong to the company. These liabilities are the obligations of the company. We haven't taken on any obligations for our CFO or any management or any employees, right? That it's all the obligations of the company. And so again, the auditor would look for evidence of that. So again, with confirmation of accounts receivable, for example, if a customer confirms, you're going to confirm that, one, yes, the amount is correct, we owe them, they owe us the money, and it's the company's right? They have a right to this accounts receivable because they engage in this transaction with the company. Ricardo, did you have a question? Oh, okay. Any questions on that? Does it make sense? Right? So when you think about assertions, right, you think management assertions, as I said, are exactly the same. Regardless of, you're going to see these same assertions when we start to talk about the sales and collection cycle or the acquisition and payment cycle. These assertions are going to be the same. As I said, what is going to change is the auditor's evidence collection procedures. What evidence are they going to collect? So also you want to think about, it's important to understand the assertions because the assertions are the framework from which the auditor develops their audit approach or their audit procedures. Then finally, the last category of assertions would be assertions about presentations and disclosure. And here we have management's making representations about occurrence and rights and obligations, and you'll see a theme here, right, in terms of assertions, right? Are the disclosed events and transactions that the events and transactions that they're disclosing, did they actually occur? And do they pertain to the entity? Is it complete? Have we accounted for have all disclosures been included in the financial statements, right? So GAAP gives us, when you look at generally accepted accounting principles, there's some items that require disclosure, right? You have to disclose the accounting policies or summary of key accounting policies. You have to disclose information about depreciation, or you have to disclose information about fair value, for example. If you're involved in, if the company has significant fair value transactions, their disclosures under FAS 157 that tells a company how you have to report those transactions, right? You have level 1, level 2, level 3. Right? They're required disclosures under GAAP, depending on the transactions that the company engage in. And so what you're looking for as the auditor is that the client has followed that, that they've adhered to GAAP, and they've disclosed those items that are required to be disclosed. Accuracy and valuation, that the financial and other information are disclosed properly and at appropriate amounts. And then finally, classification and understandability, is what you have to remember, right? The point in having generally accepted accounting principles is that you create this framework so that companies abide by this framework. You don't have companies, reporting under various frameworks. They report under GAAP, right? And because they're reporting under GAAP, that creates this some level of transparency. It creates a format that you can pick up as a user of the financial statements and see that there's comparability across companies, right? A cash means cash. Accounts receivable means accounts receivable regardless of the company, right? And that the disclosures are important to help to explain those items that are recorded in the financial statement. So you want to make sure that management is asserting that, yes, we follow GAAP. We've classified our assets, our liabilities, and owner's equity in accordance with GAAP. We've disclosed in accordance with GAAP so that the information is properly presented, in accordance with generally accepted accounting principles. So for example, with classification and understandability, if we're looking at the sales and collection cycle, the auditor would look to say, for example, accounts receivable are properly classified as short-term, right? Because GAAP says accounts receivable are short-term. Unless there's some other type of agreement that you have with a customer, you expect to collect your accounts receivable within a year time frame, right? In fact, you expect to collect them in a 30-day time frame. Rarely you're going to have accounts receivable that extend past a year, right? So auditors are going to look to ensure that it's been classified properly as a short-term accounts receivable, and any disclosures pertaining to accounts receivable have been properly disclosed in the financial statements. Okay. Any questions before we move past assertions? So let's take a look at a problem before we go on. If you look at in Chapter 3, Engagement Planning, problem number 48, 348. Take a few minutes to read through that, and let's walk through the assertions. Oh, I'm sorry, I gave you the wrong chapter. I meant to say problem 49 in Chapter 1. I apologize for that. Chapter 1, problem 149. It's on page 33. Sorry about that. 149, Chapter 1. Yes, it's on page 33. Okay, has everyone had a chance to go through at least half of them? Okay, so let's start with the PCAOB assertion, existence and occurrence, right? So what is the corresponding ASB assertion? And what's the nature of this assertion or category?
The nature should be a transaction.
So which one though? So existence. So let's start with existence. What's the nature, the category, and what's the corresponding ASB assertion?
The nature of the transaction.
Existence?
Yes.
Okay. And what's the corresponding, what would you say is the corresponding ASB assertion then? Vivian? No, okay. Existence, right? So here's what you have to do, right? And this is why. So the ASB, remember I said the ASB lumps them all together. They don't distinguish between category, but I want you to be able to distinguish between category of assertions. So existence, right? You have to first ask, well, what's the nature? Like what am I gathering an assertion about? And in this case, it's the existence. When you talk about existence, you're wanting to, the auditor's objective is, does this account exist, right? Is it a valid account, right? Because a transaction doesn't exist. A transaction occurs, right? A transaction doesn't exist. The existence of that transaction, the existence is the outcome of that transaction, right? That transaction occurred, and the outcome of that transaction is that I now have an account balance, right? I have something that affects my balance sheet, right? Because everything that flows through your income statement impacts your balance sheet, right? If I record a sale, if I sell to a customer, what's my transaction, what's my journal entry? Right. So I'm going to debit accounts receivable or cash, depending on whether it's a credit sale or a cash sale. And I'm going to credit revenue, right? Income statement, balance sheet. So it's going to hit my balance sheet. That transaction that occurred affects the balance sheet. So existence deals with account balances. Does this asset exist? Does cash exist? Does inventory exist? Those are all balance sheet accounts. The occurrence then deals with the transaction. It flows through the income statement. A transaction occurred. I reflected that transaction in my income statement. So as Vivian pointed out, existence pertains to the nature of that assertion is account balances. The corresponding ASB assertion is existence, right? For occurrence, the corresponding assertion, ASB assertion, is occurrence. And the nature of the assertion is transactions and events. Okay, everyone clear on that? Also, if you look at presentation and disclosure, there's also occurrence, right? If you look at the corresponding assertion for that, right? Okay, what about the second one? What do you think? Rights and obligations. What's the corresponding ASB assertion, and what is the nature of the assertion? What do we mean by rights and obligations? What is that? When management's making assertions about rights and obligations, what are they asserting? Not a trick question. Vivian? Right. Right. So then what would be the nature of that assertion? So So but what did she say? They own the assets, right? They are obligated to pay their liabilities. Where does that appear? Right, and that would be assertions about account balances, right? And the corresponding ASB assertion, right, is rights and obligations. Right, and related to that account balance, you would also have disclosures, footnote disclosures, right? Because your footnote disclosures related to accounts receivable, so you could also see you also see the assertion about rights and obligations appearing in the assertions about presentation and disclosure. Right, so when you think about what you need to ask yourself, when I see existence, when management's making an assertion about existence, what are they saying? What are they trying to say? What are they telling me? When they make assertions about occurrence, what are they asserting? What are they saying is happening? Right? And that helps you to think through, well, what's the nature of it? Right? What is this assertion? What type of assertion is this? What category, I should say. All right, what about the next one? Completeness. What's the corresponding ASB assertion for completeness?
The nature is transactions.
Completeness is transactions, yeah. Okay, what about, what's the nature? Okay, what's the nature of the assertion or category of the assertions? Right. So that's describing what the assertion is. But what's the category? I should say when they use the term nature, I use the term category. What's the category of the three? What's the category?
Transactions, account balances, and disclosure.
Right. So completeness pertains. The assertions about completeness pertains to all categories of assertions. Right. So in the assertions about transactions, it's just basically saying that all transactions that have occurred are recorded. All transactions that have occurred are recorded. When you reflect on when you talk about completeness related to account balances, all cash that should be reflected in the financial statements have been reflected. All inventory that should be reflected in the financial statements have been reflected in the financial statements, are recorded. What about valuation and allocation? What's the corresponding ASB assertion? And what's the category of assertion? Yes, Candace. Okay. And so you're absolutely right. Accuracy and valuation and allocation are the corresponding ASB assertions. What are the category of assertions? Right. Transactions and events, and that's the accuracy, right? That's the accuracy. So the assertion, the corresponding ASB assertion for valuation and allocation is accuracy with respect to transactions and events. And then the valuation and allocation would be what? Disclosures as well as account balances, right? Right, does that make sense? Everyone see that? So for valuation and allocation, the corresponding ASB assertions would be accuracy, as it pertains to transaction and events, and also presentation and disclosure, and then valuation and allocation as it pertains to account balances as well as presentation and disclosure. Any questions on that one? Make sense? Okay, what about finally the last one, presentation and disclosure? What are the corresponding ASB assertions? Vivian.
Classification,
Mm-hmm.
understandability,
Mm-hmm.
and then the category will be classification will be transactions, and then for understandability will be disclosures.
Yes. Okay. All right. So here's the deal. You want to make sure you understand If you look at the exhibit in Chapter 1, Exhibit 1.4, Management Assertions, you will see how PCAOB assertions relate to ASB assertions, the relationship between those. And you want to make sure. So again, I want to stress, it is important to not just know the assertion. You have to know what category that assertion applies to. Because remember, this is the framework that auditors are using to develop their audit procedures, right? They're testing management assertions. All right. So let's just summarize before we move on. Basically, as I said, auditors use management assertions with respect to their audit procedures, right? That's how they're going to do. They have to develop audit procedures to determine, does cash exist? Does accounts receivable exist? Did this transaction occur? Is the transaction that occurred recorded, right? They're going to develop audit procedures to test that. So if you have this audit procedure that says, the audit procedure that auditor would perform is review the accounts receivable with the credit manager to evaluate their collectability. So if you do this procedure, what will you know? What do you think you will know? You evaluate, review accounts receivable with the credit manager to evaluate collectability. Once you perform this procedure, what will you know? It's not a trick question. The answer is right in the question. Right in the procedure, sorry. What's the point of reviewing accounts receivable? Right, to determine if they're collectible. So, and why do you care about if they're collectible or not? Why does an auditor care? Yes, Jimmy. Well, you can have an outstanding. So if you have the deal with accounts receivable, right, is that it's accounts receivable. Somebody owes me money at year end. Why do I care as an auditor? It's right there in the procedure. Omar. Right. Right? Collectability. So part of the transaction or part of the objective with accounts receivable is not only to determine does it exist, but it's also to determine will I collect on it? Will the client collect on it? No, I don't have a crystal ball. But we know, GAAP tells us, right, that you're not going to collect 100% of your receivables. There's a high probability that you probably won't. And you have to account for that. You have to account for the chance that you might not collect 100% of your receivables. That's why we establish an allowance for doubtful accounts. The auditor has to test that allowance for doubtful accounts. One way they do that is by reviewing the collectability of procedures, reviewing the collectability, of accounts receivable with the credit manager. So once you perform this procedure, what you will know is you will have some information as an auditor about the collectability of accounts receivable, about whether or not there are any customers who are late in payment, or whether what the credit manager believes are the collectability of those receivables. Are there any customers who are overdue? What's the status of those overdue accounts? So what assertion is being tested? So we're talking about accounts receivable. So what's the category of assertion? Account balance, right? Because we're talking about accounts receivable. Accounts receivable is a balance sheet account. So therefore, if we're talking about accounts receivable and account balances, what do you think the assertion is being tested? Yes. Dennis. Existence. Existence you would test not necessarily this, right? An occurrence deals with the transaction. Omar. Valuation and allocation, right? So before you get, before you get to this point, you're absolutely right. You want to have already tested existence, right? You want to know that that account exists. So before you perform this procedure, you would have done something else to ensure that the accounts receivable existed. So here you're concerned about, because you're concerned about collectability, you're looking at the valuation of that account. So what will you know? You will know the amount of accounts receivable that are not collectible. You will know the balance that is needed for the allowance for doubtful accounts. And that way you're able to compute the net realizable value of accounts receivable, and the assertion being tested is valuation. See the relationship between your audit procedures and what audit procedures you perform and what to test these assertions that management's making. Let's look at another one. Count inventory items to verify the amount posted and recorded in the inventory account. So you're counting inventory. So what's the nature of the assertion there? What category? Let's start with that. Account balances. So you want to know something about account balances, right? Inventories and account balances. You're counting inventory items to verify the amount posted and recorded in the inventory account. Once you do this, what will you know? Vivian. Okay, so let's look at that. What you're going to know is that the inventory item that the client says is there is really there, so existence, right? Because you're counting inventory. Counting inventory is actually going out, physically counting inventory. So you know that inventory exists, that item exists. You will also know the number of items is correct or incorrect that is used in the calculation of inventory, right? Because remember, what you're doing is you're counting inventory to verify the amount posted and recorded in the inventory account, right? That's what you're doing. So you're counting that inventory, and you're going back and checking that against what the client has posted in their books and records, what they've recorded in their books and records. So what assertion is being tested? The first point, you're testing existence. The second, you're testing valuation. Remember, inventory is a balance sheet account. Accounts exist, they don't occur. Accounts occur as a result of a transaction, right? Okay. Obtain a letter from management stating that there are no unrecorded liabilities. What's the category of assertions? Ricardo. Category. Let's start with category. Category of assertion, not the assertion itself. What category does it fall under? Remember, there are 3 categories? Right, so which one does this one fall under? Account balances. We're talking about liabilities, right? Candace, was that what you were going to say? Right? Obtain a letter from management stating that there are no unrecorded liabilities. So what's the auditor concerned about here? What's this telling us that they're concerned about? Yes. Tell me your name again. Cody. Right. They want to know that all liabilities that should be recorded have been recorded. Completeness. The auditor will know that management says that they've recorded all the liabilities that should be recorded. They haven't left any off. That's completeness. Right? What a search for unrecorded liability, what the auditor is concerned most with liabilities is that they're understated, right? As opposed to sales or revenue where they're concerned about overstatement. Because if you think about if management has objectives or incentives to manage their earnings or manage the financial statements, they're not going to try to overstate liabilities. It's rare that they would try to overstate liabilities, right? So it's more likely that they're going to understate liabilities, and vice versa for sales and revenue. All right, any questions? We're going to keep coming back to assertions, and if it feels like I'm beating you over the head with assertions, I am. And you will see why. Right? It's extremely important. You have to understand assertions because assertions are the foundation of the audit approach and plan. Okay? All right, so let's just quickly summarize this topic. Audit plan basically is the auditor's approach, right? And if Friday we're going to talk about the audit risk model, and with the audit risk model you'll see how the auditor develops their approach to the audit based on their risk assessment, right? So there's a risk-based approach, and so the auditor plans their audit, this risk-based audit, how much work they're going to perform, but they have to come up with what are the audit procedures that the audit, based on this risk assessment, right? What are the audit procedures that the audit team performs to gather sufficient, appropriate evidence, right, in order for them to form an opinion on the financial statements? That's the audit plan in detail. And so in the audit plan, the auditor will describe the procedures that they're going to perform for each cycle. So you'll see, when you go out, if any of you have done internships or you will do internships, you'll see that they have audit procedures, an audit program. And that lays out the auditor's program. And then the auditor also has to determine, well, what's the nature, timing, and extent of my audit procedures? So for example, if the client has very effective internal controls and the auditor determines we're going to rely on internal controls, we're going to test internal controls to ensure that they're working as we expect them to be. So we might, if the client has a really good environment and system, the auditor will probably go in and test internal controls during interim testing. And interim testing is some period before year end. They'll go in and test the controls. But that's only going to happen if they feel like they can rely on internal controls. And if they then determine, okay, we've tested the controls are operating as we expect them to operate, we can rely on them, that's going to change the nature of the testing that they do. So they're going to do more tested controls, tested transactions, and fewer substantive tested details. Right? So that will change the nature of the testing that they do, versus if they can't rely on internal controls, they're going to have to look at a lot more transactions and a lot more detail. Right? They're going to have to do a lot more of a detailed audit. So they're going to have larger sample sizes, for example. They might look at, as opposed to looking at, and I'm simplifying it, and we'll talk about this in more detail when we talk about audit approach, but they might look at 50% of accounts receivable if controls are effective, and if they're not, they might look at 90%. And that's just an oversimplification. But that changes. Having ineffective internal controls means that you have to do a lot more work because you can't rely on it. You have to gather a lot more evidence because you can't rely on the client system of internal controls. So audit procedures, basically, we talked about the audit procedures. The audit procedures are the approach, the steps that the auditor takes to gather evidence. Okay? And we saw with the assertions how those audit procedures are developed based on testing management assertions. So things that the key audit procedures that the auditor performs would be the risk assessment process. So that's in the planning stage of the audit. We'll talk about that more, risk assessment, when we talk about the audit risk model. And we talked a little bit about that when we were talking about engagement planning, where the auditor is getting information about the client's business, what's going on in the industry, doing ratio analysis or analytical procedures to be able to identify where there are potential problems. Looking at the, what about management integrity, tone at the top, right? So that's the auditor gathering in the planning phase, making an assessment about the riskiness of the client. The other things that the auditor do is they test controls. They look at the effectiveness of internal controls, and they test that to determine whether or not they can rely on internal controls, and also that the controls are operating as they would expect. And then the other set of audit procedures deal with substantive procedures, where the auditor is gathering evidence to test management's assertions about the financial statements. So if you look at just relaying or tying audit assertions to evidence and audit procedures, for example, let's focus here on this column dealing with the ASB assertions. You'll see that, for example, existence. I'm not going to go through all of these because we've kind of covered them, but existence. Do the assets recorded really exist? And so examples of that would be the physical presence of the asset. So for example, the auditor might inspect inventory, might inspect property, plant, and equipment. They will confirm accounts receivable. They will confirm cash, right? Because they're trying to test the existence of that asset. Occurrence. Those are transaction related. So did the recorded sales transactions really occur? Right? That's the key question the auditor is asking. So they want to get evidence of the client shipping documents, as I pointed out in an earlier example, right? Because shipping documents would suggest that ownership of that asset has now transferred to the customer once we ship it, FOB, right? And so the auditor would vouch. They would select a sample of shipping documents from the client's books and records and tie those, they would select a sample of sales from the sales journal and trace those back to shipping documents, right? Because what they're concerned about is, did it occur? I've recorded this sale in my sales journal, so now I want to make sure that it's actually a valid sale, that it occurred. So that's why I'm going to start with my sales journal and tie that back to the shipping document. Why wouldn't I do it the other way? Why wouldn't I go from the shipping document to the sales journal to test occurrence? Why would that not be the appropriate procedure? Why do you think? What am I concerned about with occurrence? Well, it's recorded, right? Occurrence knows, occurrence is saying what's recorded actually occurred. Management is saying what I've recorded actually happened. But what's my concern as an auditor? That it actually happened. So I'm concerned about overstatement with respect to sales, right? So why wouldn't I go from the shipping documents back to the sales journal? Why wouldn't that make sense? Why am I not starting with the shipping document to test occurrence? If I'm concerned about overstatement. Shipping to sales.
So what are you saying, it should be sales to?
Right. It should be. It is. That's the right way. Sales to shipping. But why is the other way not right? John.
Someone could maybe tweak the shipping documents and make it look like something is shipped but hasn't.
Right, well that exists anyway, right? That exists going the other way. The reason that you're not going to start with shipping, because if we go with the premise that if it's been shipped, it's an accurate sale, right? That's going to tell me completeness. That's going to tell me, because the shipping documents tells me, right, if I go with that premise, shipping tells me that it should be recorded, right? Shipping says I sold something and it should be in my sales journal. That gets to completeness, right? That tells me that when I start with the shipping document and tie it back to the sales journal, that tells me that everything that I pushed out the door is properly reflected in my sales journal. That gets to understatement. That doesn't tell me anything about overstatement, right? Because I want to know that everything that's recorded over here in the sales journal is valid, right? So the only way to know that is to randomly select from the sales journal and ensure that there's a shipping document to support it, right? We don't want to start with the shipping document to test occurrence. We want to start the other way. We want to know, because we're concerned about overstatement. So we want to know that everything that's recorded here in this sales journal has a corresponding shipping document to support it.
If you start with the shipping documents, and the shipping documents you will literally will have to have a sales journal.
Well, right, but you would want it to, right? But that gets to completeness, right? Because the shipping document is telling me a sale occurred, right? If we go with the premise that a shipping document is a proxy for a valid sale, which is a good proxy, that is just telling us that a sale occurred, right? That happened. So now I want to know, should it be, I want to make sure from going from the shipping document that it's reflected. That tells me, that gets to understatement. That's saying, I want to make sure that everything that should be recorded has been recorded. The other way, the overstatement, I'm concerned that they might have put some fake sales in there, some fictitious sales in there. Because technically, if it's a fictitious sale, and assuming that they haven't doctored up a shipping document, right, to support it, assuming that it's a fictitious sale, there won't be, that means that no shipment occurred, right? That means that no shipment occurred, or a shipment, no shipment occurred for a valid customer, or a shipment wasn't made to a valid customer, right? So that's why when you are testing occurrence, you're going to start with the sales journal. Does that make sense? Okay. All right, so again, that's just kind of relating the assertions and the evidence and the audit procedures. Let's look at one more. Rights and obligations. So here the key question is, does the entity really own the asset? Are related legal responsibilities identified? So in this case, key examples of audit evidence would be audit evidence from third parties. Third-party audit evidence such as confirmations, such as getting confirmation from attorneys about liabilities that exist, legal liabilities that exist. So, or cash confirmations from the bank about the bank balance. All right. Notice also, I just want to point this out here, when we talk about presentation and disclosure, again, the ASB assertion related to that would be understandability, and basically are the presentations and disclosures understandable to the users. And so your audit evidence is management prepared financial statements, right? Because it's management's responsibility to prepare the financial statements, and auditors are going to review the financial statements and what the disclosures that how the presentation and the format of the financial statements, as well as the disclosures related to the amounts recorded in the financial statements, and that's inquiry. So some of your audit evidence is obviously going to come through in the form of inquiry. So types of audit procedures. The types of audit procedures you're going to basically, in their standard audit procedures, is inspection of records and documents. The client's records or external documents or internal documents when you're testing internal controls, for example. And normally you see the terms vouching, tracing, and scanning. You vouch documents, you trace. You select a sample of shipping documents, trace those back to the sales journal. You select a sample of sales from the sales journal, vouch those back to shipping documents. Tracing, vouching, and scanning. Inspection of documents. Inspection of tangible assets, such as inventory, such as fixed assets, such as cash, right? Or if the client has on its site, stocks and bonds, things of that, can inspect those things. Observation, right? By observing the physical inventory count. The client performs it, it's the client's responsibility to perform inventory counts, right? An auditor can observe those inventory counts, and then they can also do test the inventory counts that the client is doing. Inquiry. There's no audit that you're not going to inquire. There's certain information that you're not going to produce necessarily a document. Not all of your audit procedures involve documents that you can actually touch and feel, right? You inquire, so think about the one procedure we talked about earlier when we were talking about the credit manager. Inquire, discuss with the credit manager the collectability of accounts receivable. That's a discussion, right? Where you document the credit manager's rationale, You document all of the accounts receivable you discuss and the outcome of that discussion, and then your conclusion based on that discussion. That's inquiry, right? There's no documentation necessarily to support it. It's your discussion with that person in management who's knowledgeable about the account and the transactions. Confirmation is just as it says. You confirm account balances, such as accounts receivable, such as cash. And in some cases, you might even confirm liabilities with a third party. So you're seeking confirmation of those transactions or accounts, right, with the third party. Recalculation is just as management calculates something, you go in and recalculate it. Same thing. Reperformance, reperforming a procedure so for example, with internal controls. If you're testing internal controls, you actually perform the steps necessary to support the account balance. So for example, or the transaction. If management is supposed, when a customer makes a sale, if it's supposed to go through these 3 steps, you as an auditor will reperform that process to ensure that that transaction those controls are operating as management explained them to be. And then we talked a bit about analytical procedures in the planning stage. And analytical procedures are basically ratio analysis, looking at year 1 to year 2, comparing it, looking at relationships in accounts. 2 things that I want to say about, 2 points I want to make about analytical procedures. Analytical procedures are can be performed throughout the phases of an audit. So it can be performed during the planning stage, during the evidence collection phase, and during the completion phase. The standards require analytical procedures to be performed during planning and completion. It is optional to the auditor if they perform it as a means of evidence gathering during the testing phase. The objective of analytical procedures during the planning phase is attention directing, right? Because remember, at the planning stage, the auditor is going through their risk assessments. They're trying to identify where there are possibilities of misstatements. Where's there a higher likelihood of misstatements? What accounts? So for example, if the auditor is looking at, I'll use this one again, sales and collection and the accounts associated with the sales and collection cycle, and they notice that sales are going down, however, accounts receivable is going up. That's not the right relationship. That relationship doesn't make sense. So this is during the planning phase. So the auditor's attention is directed to the fact that there might be a collectability problem with accounts receivable, so that they know in designing their audit procedures that the allowance for doubtful accounts or collectability of accounts receivable is a higher risk account. Right? So they're going to develop their audit procedures around that to focus on the collection of accounts receivable. So analytical procedures are attention directed during the planning phase. And if you think about it, you don't know anything. The analytical procedures can only say there's a problem or there is no problem. These accounts look good. The relationships are going in my expected direction. That's all they can tell you, right? And then during the completion phase, analytical procedures are also required. And that's again to kind of like a hindsight. Now I have a lot more information because I planned the audit, I've carried out the audit, I've collected evidence. Now I want to see, does it all make sense? Does it pass the smell test? Do I feel as though I have gathered sufficient appropriate evidence to support my opinion? After I've gathered all this evidence, is there anything that stands out that just doesn't make sense, right? So in the completion phase, it's sort of like a hindsight check. Let's kind of take a step back and look at what we have, and does it make sense? Okay, so only required during those 2 phases of the audit, but can be performed during the evidence collection phase as well. I'm just going to say about audit documentation. Obviously, we know how important the auditor's documentation is. So those are the auditor's work papers. The work papers have to support the work that you did as an auditor, and they have to be able to support the opinion that the auditor is giving on the financial statements. And so it's extremely important. Audit documentation is extremely, extremely important. We saw what happened when Anderson destroyed documentation. Key things, evidence. You have to have, especially with publicly held companies, with the PCAOB coming in and looking at publicly held companies, you have to be able to support, someone has to be able to pick up those work papers, review them, and be able to say, okay, I see how you arrived at this conclusion. Let's see here. Okay, I talked about that audit documentation is going to be reviewed by an experienced person. So what you'll see, there are different levels of review. It's going to be reviewed, obviously, if you're the staff person, you're performing the work, your work is going to be reviewed by the senior and possibly again reviewed by the manager and so forth. So there are different levels of review. I also talked about a concurring partner review. The current concurring partner is going to come in and look at the audit documentation, especially for mostly in those areas where there's more high risk, those high risk areas. Obviously, as I said, it has to support your conclusion and opinion reached. There's always been a documentation retention policy. Firms have their own documentation retention policy, but so does the PCAOB, right? And so auditors have to finalize their documentation within 45 days of the release of the audit report, and that's the release of the audit report they have to finalize, and not the release, not the date that they sign off on the financial statements. And also it has to be retained 7 years from the report release date. Those are the two key changes.